Hello, and welcome to another very acquisition-y episode of the Working Without Pants podcast. And I say today's episode is acquisition-y because we're talking with Amanda Dixon of Barney all about agency acquisitions. So Barney is an M&A firm that focuses specifically on digital agencies. And so we dive all into what drives agency acquisitions, what agencies can do to prepare for a successful acquisition, all sorts of what's happening in the market right now, how to think about this. We talk about earnouts. We talk about tech-enabled agencies and when people are building their own proprietary tech while building their agencies. Really interesting stuff here. So I got a ton of value out of this. I interviewed Amanda because I'm on their email list. I find their newsletter and just the listings of all the agencies that they're putting up for sale really helpful. And so I wanted to just pick her brain and get information that I wanted to know from them. So hope you found this useful, and thank you for taking the time to listen. And before we dive in, though, I am going to point a quick shout out to the sponsors of this episode.
This episode is brought to you by Content Allies. We help B2B companies launch revenue-generating podcasts, build relationships that drive revenue through podcast networking. At Content Allies, we set up weekly interviews with your ideal prospects and strategic partners. You show up and have engaging conversations. We handle everything else. From show strategy and guest outreach to audio production and podcast syndication, we do it all. With packages starting at $3,000 per month, we make podcasting an ideal growth channel for you. Learn more and say hello at contentallies.com. And if you're a listener but not an ideal customer for Content Allies, then be sure to take advantage of our referral program. We pay out a 10% commission on any customer you refer our way. Just send an email introduction to Jake at contentallies.com. All right. Hey there, Amanda. Welcome to the show. Excited to have you on here. And the first question I have for you is, are you wearing pants right now?
I am wearing pants. We are in the office and my team is here. So I sure hope so. We're innovative, but not that innovative.
That is fair. And so I'm curious, why have you guys chosen to, I guess maybe you're in New York City, you just need to get out of the house, but why have you guys chosen to do an office versus remote and kind of a world where it's kind of like digital agencies, a lot of remote going on?
100%. So we're hybrid. People can work from home if they want to. We have people kind of spread out all over the country too. That definitely happened during COVID. So everyone has the option to be home, but because we're in New York City and everyone lives in basically a shoebox and most of us have kids, we have the option to come in the office and find that most people do.
That makes sense. Yeah. I think, it probably all depends where you live in the country on if the office makes sense. So
100%. Most people don't have a home office in New York City because, you spend an extra $3,000 or $4,000 a month just to have that bedroom. So we have this wonderful office space.
That makes sense. I definitely get that. Awesome. Well, I'm excited to dive in. And so for anyone in the audience who doesn't know who you or what Barney is, can you give us the quick kind of just overview of what you guys do?
I would love to. Absolutely. So we're an M&A firm for agencies. We help founders exit or go through an acquisition event when they're ready for a change. We just focus on agencies, predominantly digital, just because that's the nature of where the agency world is today.
Awesome. That is great. And as I mentioned when we were chatting before, but I love following your guys' newsletter, just seeing the updates whenever you guys kind of put out an email. Hey, this is the type of agency. Here's the rough information. Here's the revenue. Here's the profits. Here's what they're asking for. So I find that to be really, really helpful. And I've been following that for quite some time. So find your guys' newsletter really useful, which is why I wanted to have you on the show here.
Awesome. Thank you. We try and look at what everyone else is doing in the space and literally do the exact opposite. So everything from, just having kind of current listings with an actual ask price to, giving as much information as we can without obviously breaking any confidentiality challenges is something that we have found our audience really likes.
Yeah. I'm curious, you guys mentioned that you started this due to the frustration with other, firms or brokers in the market, which I have spoken in length about on my previous attempt to sell one of my agencies. That kind of went horribly. And I'm curious, what have you guys learned, or what have you found that, how do agencies need to be approached differently? Because most of these, broker firms just kind of work with anybody. And I'm curious how you see agency acquisitions needing to be handled differently.
Yes, 100% different than selling a traditional business. I don't know how anyone could fully understand the agency space unless it's a huge component of your business. There's a few main reasons why. One, in the agency space, We really focus on the human capital component. There's no tangible assets with an agency. It's really people, and people being your team and people being your clients. And that's really it. That's the bulk of what you're selling. So understanding, one, how to value digital assets is really valuable. And then secondly, most people that are selling these agencies are not retiring. We're not dealing with people that are looking at selling and living on a beach for the rest of their life. If they are, they'll probably be starting another agency. So it's a really interesting mindset. Most either investment bankers or business brokers approach business acquisitions for people that are, in their later 60s and kind of done working. We recognize in the agency space, just by the nature of it being very digital and tech heavy, most of the folks we're working with still have a long career ahead of them. So totally different deal structures. And then the last thing I'll say is the type of buyers in this space are really, really innovative. So, when you have innovative younger sellers and you have buyers that are innovative and on the forefront of digital transformation, the way that the financial industry has approached mergers and acquisitions and going through these sales is just completely backwards. Having it take 9 months, putting together these 70-page Word documents of text about a business that no one cares about, having representatives that know how to, really read a P&L, but don't know how to have a normal conversation with someone about what strategic value might bring. All of those things are just very, very different in the agency space.
Now that makes sense. And I definitely get that. And I think that was much of the experience I had trying to go through it was just like, this guy does not understand my business at all. And it was a horrible experience.
Yes.
So yeah.
Yeah, and valuing digital assets is really challenging. It's really different than valuing a traditional business. And the buyers are not location based. It's even more so post COVID. But the buyers here are just they're really looking for strategic value and human capital. So having a really industry specific buyer pool is the only way that we can get these things done in the time frame that we're able to do that.
And I'm curious, with the buyers that you guys are seeing that are kind of moving on the market today, are these kind of cash lifestyle buyers that want a business? Are these strategic larger agencies buying smaller ones? Like, what are you seeing as kind of general trends as who's buying these days?
Yeah, great question. So there's really three main types of buyers. So you've got the first that you talked about, which we would call an entrepreneur buyer. So that's someone who maybe, is stepping out of a role at Facebook or Uber or Amazon. It's like, okay, I can do this. I want to do it for myself, but I don't want to build it from the ground up. It could be someone who just sold an e-com store and is like, all right, I'm really good at this. I want to do the marketing piece of that. We see a lot of entrepreneur buyers. They typically cap out at about $1 million in purchase price, just because the financial component of it becomes more than many single entrepreneur buyers can handle. When you look at, a little bit larger of an agency, the right type of buyer is typically a strategic. So that's another agency who's just looking for a bolt-on. So that could be someone who's really good at performance marketing, who needs to add a creative web dev or product dev shop into their performance capabilities, or vice versa. And then the last type of buyer that we see really comes into play when you hit that $1 million in EBITDA. So the bottom line number is showing more than $1 million. That's a financial buyer. And those are typically private equity groups that are looking for a short-term 3 to 5 year hold. They're going to pump the business with money. They want founders that are going to stay on board and then, sell you for more in a few years.
That makes sense. And so I'm very curious on that last one, because I guess that's my target. And you mentioned the founders wanting to stay on board. So when you hit that $5 million mark and you're doing the financial exits, I guess that's a question maybe it would be helpful to understand maybe on all of those levels, but I guess I'm curious on the last one personally. What are you seeing in terms of like earnouts and with these agencies, like people having to stay on board, like what's the typical structures you're seeing?
Yeah, great question. So it depends on the risk profile of the business, and things that constitute risk in an agency are: one, client concentration. So if you have one client that's more than 10% of your revenue; two, the type of revenue that you have. So whether it's recurring retainer, which we typically see for performance agencies, versus a creative shop, which is typically more project based. It could be, the size of your team. If it's just, a founder with freelancers versus, 100-person agency, obviously there's more risk profile associated with the smaller team with no management outside of the founder. So we look at all those types of things. the buyers specifically are going to try and structure a deal that mitigates their risk. As a worst case scenario, I would plan on 50% cash at close, kind of guaranteed. That's what you're going to get when you sell an agency. And then the rest being paid in a multitude of different ways based on who the buyer is, but that's really dependent on what happens after the sale. So everyone has heard horror stories about earnouts. They get this terrible bad rap. The reality is earnouts, when structured properly, aren't terrible. The goal with an earnout from our position, if we're representing the seller, is to, say, all right, as long as the business doesn't implode, they get this money. We don't want to have to see an earnout based on rapid growth. That's not really, that's not really an earnout. That's saying you keep working in the business and kicking ass, and then we'll pay you for it. What we're seeing a lot of buyers shift to, though, for that other 50% is rolling over some chips. So essentially rolling some equity into either a larger strategic or into a financial buyer. Sometimes that can just be profit sharing, sometimes it can be phantom equity, and sometimes it can be true equity. And the reason that we're seeing, I think, buyers move to that model is because it aligns incentives. So in a traditional earnout model, if you're the founder and you go through an exit and you're in, year one and like, man, we really need to make a big hire. I need to hire a COO. Or my COO left, I need to hire someone better and the market's changed and they are $150,000 more. You're going to be more reluctant to make the right decision for the business because you're trying desperately to hit financial targets. And that doesn't serve anyone well in the long run, other than you trying to hit this earnout. But the reality is that's what people do because they're trying to hit the earnout. So we're seeing a little bit of a shift to more of a hybrid model, but nonetheless, I would plan on 50% cash at close and then the rest, being paid on what happens after the sale.
And how long is that term you typically see on like what happens to be paid? Is that typically 6 months, a year, 2 years? What are the kind of typical terms you're seeing there?
Yeah, so for smaller agencies, it's typically a year, maximum 2. And for smaller agencies, you may not even have contingencies. It may just be, we're going to pay you monthly out of the cash flow of the business for 2 years, and you can go on your merry way. You don't have to necessarily stick around. For larger agencies where the founder is more integral and there's more risk just because of size of the cash payment that was paid at close, I would plan on sticking around at least for a year. If you can stick around for a year, when you're going through an exit, you will get top dollar. If you want to bounce in 90 days, it's doable. And there are buyers that are okay with that, especially strategics that have, an existing ecosystem, but you just don't have as many options. And the key is to have options when you're going through an acquisition, not just to have one offer.
That makes sense. Okay, so I want to shift now over and kind of discuss a bit on multiples as well. And I know you guys have some amazing content on your site and articles and decks around kind of what drives multiples. One question I'm curious, though, to kind of start off on this, and I'm sure this will kind of like segue into the multiples, but based on like the newsletters, the listings you guys put an asking price. I'm curious, what do you typically, like if you had to look average across the board, like what are people actually getting versus like the listed access asking price?
Gosh, people ask us that all the time. It's a great question. We get what we ask for a business. And here's why. If we were expecting, or our sellers were expecting 100% cash at close guaranteed, we obviously would not be getting the full ask price. But because there's incentives aligned with buyer and seller post-transaction, we can always bridge a valuation gap with deal terms. So let's say it's a $5 million transaction, you get $2.5 million at close, and the other 2.5 is paid kind of over the course of 2 or 3 years, just based on maintaining revenue. If the revenue maintains for 2 to 3 years, that business is absolutely worth what we've listed it at. If the business doesn't maintain revenue, it's not, but that's okay. The buyer doesn't have to pay it if it doesn't maintain revenue. The challenge in the agency space with valuations is that agencies grow rapidly. And the old school way of doing valuations is to average 3 years of historical financials. That's not what happens in the agency space. No good person in our position is going to suggest that, because you probably have experienced 30, 50, 100% growth year over year, especially for smaller agencies. They can grow so rapidly. So we set aggressive valuation targets and hit them, but with the caveat that you're not getting 100% of that as guaranteed, in the bank when you sell.
Okay.
That makes sense. So yeah, basically what you're saying, like those listing prices are decently accurate, but it's again just not like a straight cash deposit. It's going to be a mixture with that.
100%.
Okay.
Exactly. Yep, exactly. And that may change if the market shifts. I'll let you know. I'll keep it posted. But at this point, and for at least the last 24 months, that's where we've been hitting.
Okay. Makes sense. And then I'm curious, also, you've got a bunch of this on the site, but I'd love to have you maybe explain for the audience as well, just kind of what are some of the top things that drive multiples for agencies as well?
Yeah. So the biggest is the type of work that you do as an agency. And the reality is what's cool and sexy changes a little bit. So influencer agencies 4 years ago, everyone was paying a premium on. Today, influencer agencies are struggling because some of that has been replaced with technology. So multiples have gone down a little bit. They were kind of at the height, and they're creeping down a little bit. Right now, we're seeing a premium on things like HubSpot, ABM. Folks that are doing sales enablement, email marketing. We're seeing anyone around storytelling, shifting away from, more traditional just content development. Anything that's around storytelling is definitely seeing a premium. But that definitely goes into it. It's just kind of what you do and what the market demand is at that time. The things that are a little bit easier to control. One, the type of revenue. So project versus retainer. That's obviously really important for buyers. Ideally, you've got 100% retainer. Most folks don't, unless you're straight PPC or straight SEO. Most folks have a hybrid, and that's okay. 100% project-based businesses are just inherently riskier. So you do take a little bit of a knock in multiple. The other things that buyers definitely look at are your brand reputation. So what happens when they Google you? I know that sounds really silly, but what does your online presence look like? What are your Glassdoor reviews, if you have any? What does your LinkedIn profile look like? All of those things are, things that definitely get looked at. What's really important to a buyer outside of the components of the business and the clients are just the people. So, outside of the founder, who else is there and what do they want to do long term? Do they want to stick around or not? So that's kind of a high level of the things that are the most important. I'll say that, what's important to one buyer might not be important to another. So outside of those main things, which everyone obviously cares about, for one buyer, let's say they just do SEO and they just want to buy as many SEO companies as they can, they're going to be looking at different things. They're going to care less about certain components that someone who doesn't have any SEO and they need someone to come in and really be the leader within their ecosystem. They're just going to look at different components of the business.
Okay, that makes sense. And I guess kind of like on that tangent as well, like what advice would you have for agencies who are wanting to, prepare for a successful exit or a lucrative exit? They want to kind of like, work the years leading up to that to really make sure that they're getting top dollar for whenever they do go to an exit.
Yeah, I would say the one thing that, we always tell founders is once get evaluation. We'll do evaluation and most folks in our role will do evaluation at no cost anytime. So start there so you can see where you are. And then let's work backwards. So, we can touch base once a quarter and just say, all right, where are you at in relationship to where you want to go? And what's the market doing today? So engage someone like us. It doesn't have to be us, but someone like us who can help kind of guide those valuation conversations early on. Once you have an idea of where you are and you know where you need to get to, it's easier to make decisions around scaling. So we see people nervous to scale all the time. It's hard to take, especially as a small agency looking to scale up, it's hard to take some leaps of faith, especially when it comes to reinvesting in people. But the reality is, if you want to hire multiple, you've just have to get bigger. And then the last thing I would say is, outside of mitigating risks, so, client concentration and some of those kind of key components of risk mitigation for businesses, really focusing on staying innovative in the marketplace and being true to what you're really good at. So if you do, creative services for healthcare agencies, it's okay to stay there. You don't have to scale up. You do not have to expand, into everything for healthcare businesses or, creative services for all businesses. It's okay to be hyper niche. And sometimes we encourage folks to stay as niche as you possibly can.
Nice. That makes sense.
And so one of the other things I guess would be interesting to know as well is, I guess I'm curious, like, so agency multiples, it's just interesting because like they're never, until you get really big, they're often like not that crazy, especially when you look at, like, compare them to the SaaS multiple world, where it's just kind of, and this is kind of just painful to talk to some of my friends in the SaaS world. And I'm like, are you kidding me? Like, and
Right.
and so, in a lot of cases, people can honestly just make more money if they were to hold the company for another, 3 to 4 years. And so what are the main motives that you are seeing for agency owners that are wanting to sell?
You're right. In the agency space, to the benefit of some, we do get multiple arbitrage. So the bigger you are, the bigger your multiple, just because there is that human element. The larger you are, the less risky that you are for a buyer. So you're correct. In smaller agencies that are getting a 3 or 4 times X, it might not make sense to go through an acquisition just from a pure play financial standpoint. The reality is, when people choose to sell at that point, it's for a multitude of reasons. One, they recognize that their clients need them to scale and their team needs them to scale, but they don't want to take the investment risk. Oftentimes, to scale, you have to invest in a layer of management underneath the ownership, and that can be costly, non-revenue producing. It's hard to scale up over that bump. So we get a lot of people that want to sell, once they hit that kind of threshold where it's 10 to 15 employees, because you've got to start adding in some management. Outside of that, it could be that they're just not into it anymore, that it's something that they're like, all right, I started as an SEO freelancer in college and I've done this for 8 years, and I recognize, like, now I'm 30 and I don't really give two shits about SEO. So I'm ready to, kind of move on and do something else. That, we see that a lot too. I think, people look at an exit oftentimes, or an acquisition, as a finite end to being a business owner in that particular business. And we always try and encourage people to think about what would happen if you sold a business, but were able to stay on board as an entrepreneur. The buyer was able to come up with an offer for you that still compensated you as an owner, but you took your chips off the table. You put some money in your pocket and do the right thing for your family, but you still get to be compensated as an owner, participate in the upside. And we're seeing a lot of structure like that now to get people to go through an acquisition.
Okay, that makes sense. And so you're kind of talking about, I guess, like you said, someone who maybe rolls a bunch of that acquisition into equity in the acquiring company so that they can still kind of be like their creative aspect there, or kind of an advisor, and get to do the fun stuff versus all the stuff they had to do previously.
Potentially. Yeah, exactly. So it could be, like I said, equity. It could just be a really great profit sharing scenario. So, as long as you're an employee of the company moving forward, you get, to participate in some really, really lucrative profit sharing. So the money you're making at the end of the day could be the exact same year over year, but the business is just really exciting. It's growing more rapidly. So they've pumped it with money. You've got cross-selling opportunities. Your team has so many more opportunities than they had. So sometimes people sell or go through these acquisitions because they've kind of hit a ceiling of what they're able to do professionally, and they're ready just for the next chapter.
Nice. That makes sense. Another question I want to talk about is, I guess, I'm not sure how many of these scenarios you guys come across, but I have a lot of agency friends that are basically building software with their agency profits to try to kind of almost, I guess, build a software tool that they run their agency on, and then hoping to kind of spin that into a separate thing and make themselves clients, or be sold as like a software platform as opposed to just a straight agency. And I'm skeptical of this approach, but I'm curious what you're seeing. Is that like a viable approach that you're seeing some agencies take that let them get closer to SaaS multiples?
Yeah. So people want SaaS multiples all the time, right? Because they're double. So when we give a valuation, they're like, but we have a technology. So here's kind of the benchmark where the world is today, the agency acquisition world is today, with the caveat that this could change because things change all the time. But where we are today is, if the software is not being monetized outside of the agency, it's just replacing Asana or Monday.com or some other kind of project management software. And a lot of buyers view that as a money suck. They would rather agencies utilize project management systems or ecosystems that are managed by tech companies, not service-based businesses. We have seen it done as a spinoff where, sometimes people will want to go through an acquisition because they've built a tech platform, and that's more exciting, that's more lucrative. So they want to sell the service business and keep the tech business. That's fine. That's okay. You're not going to get a SaaS multiple for that, obviously. So if it's a truly separate company that's built out of the agency, sure, that's monetized, through clients and end users, great. But not if it's just supporting the agency operations. That in no way makes you a SaaS, unfortunately.
Yeah, that's kind of what I gather. So from what I'm hearing, it sounds like in most cases you're seeing it either spun off as its own separate thing, because at that point where it could be sold as its own separate thing, it'd probably have its own profit and loss.
100%. It has to be its own entity, its own P&L, its own clients. We see that a lot. Well, we see it across all the different facets of the agency landscape. One that's coming to mind right now is influencer. With the rise of influencer tech, influencer agencies that were getting clobbered by this tech, so we need to build out our own, and this is going to be our go-to-market for clients. And the reality is it probably helps them get clients. I'm sure that it does, that they have this dashboard and this ecosystem. It's the proprietary software. We've taken those to market, and buyers are like, that's great, but why don't you just use a platform that's already built, that's owned by an influencer tech company, because you're not, you don't have a 200-person IT team or dev team that's building this and keeping it current and fixing all the bugs. You've got two people that are, really siphoning from your P&L. So it's an interesting conversation we have often.
Yeah, that's super interesting. And so in those cases, it probably would make sense to approach those as like two different sales, essentially, if someone were trying to go through
100%. Well, and it's the SaaS is not sellable at a SaaS multiple unless it's being monetized. If it's being monetized with a client that's different than just the single agency, then great. But most of the time, that's not the scenario.
Makes sense. Yeah, super, super interesting stuff here. This is super helpful. I guess, any other things, like that you would share for agencies, or any other thoughts of advice or things that trends you're seeing, just anything else that'd be useful for the audience to know?
Yeah, I think one of the questions people ask all the time is what is going on with the market, and is the market sustainable? It seems like everyone is going through an acquisition or having a conversation around acquisition. So, a couple of things that we think have happened in the marketplace. One, it's a little bit of a race to the top for these really large strategics that are trying to get to the magic 5 million EBITDA number, that magic and a 5 million EBITDA number. So, if they're at 3 million in EBITDA, it's a great way for them to get to 5 million by buying up a couple of agencies. Once they hit that number, they can go to private equity and they can get a really good, 10, 12x exit. So we're seeing a little bit of a race to the top there. I think the WPPs and Omnicoms, and even like the recent success of Stagwell and them going public with Code and Theory and 72 and Sunny as their flagship platform companies, it's made it really cool and sexy for businesses to go through these acquisitions. Outside of that, we're seeing a demand on the brand side. CMOs used to say, all right, I want one agency to do social and one agency to do SEO and one creative agency. And now we're seeing brands shift a little bit and say, all right, I want one really great agency of record who's going to have all these capabilities in-house. I don't want the agency of record to sub this out. So I think for larger firms that are agency of record size, they're looking at smaller agencies saying, all right, it's easier and cheaper for us to buy it than it is for us to build this ecosystem out. And then lastly, it's hard to get top talent. So someone like yourself, Jake, isn't going to go work for a large agency. They probably couldn't pay you any amount for you to give up, your lifestyle and, anything like that. So they have to do it through acquisition. To get really good talent and hook them in, they've just got to do it through buying them instead of, trying to go out and hire folks.
And so I'm curious, do you think these trends are going to sustain like this? Do you see this kind of being like a bubble that will kind of calm down at any point? Like, what are your thoughts on like the sustainability and where the market's at today?
Yeah, I think it absolutely is sustainable. I think it will shift on which facets of the agency world are hitting these really top multiples. I think that's constantly evolving and changing. But I do think that it will. I think that it will stay. And COVID, as challenging as it was personally, I think for everyone, and we certainly don't take that lightly. For the digital ecosystem, in the agency world and for the folks that service agencies like us, COVID, I think, has really exacerbated the need for very rapid growth in the digital space. Everyone was saying digital transformation before COVID. No one was doing anything about it, but they were saying it at large brands. Now they don't have a choice. So I think, we've got so much catch up to do there. We've got a really nice runway in front of us.
Yeah, that's great. Awesome. Any other final thoughts or any other kind of words of wisdom for all the agency owners out there?
Oh, gosh. I would say don't be afraid to scale. Don't be afraid to reinvest. Believe that, the market's going to stay where it is. And, know that by hitting just a couple milestones bigger, when we talk about financial milestones and net income and EBITDA, a few milestones bigger can change a really good exit to one that's just life changing. So we see people come to us all the time that we think have maybe sold themselves short because they're nervous. And then they call us 6 months into an earnout and they're like, well, I'm crushing it. The business is making so much money. Yeah, the business was doing really good beforehand. You just didn't necessarily believe in yourself. So, we're happy to help anytime, like I said, with valuations and things like that. But I think just believe in yourself and keep building and scaling if you like what you're doing.
Awesome. I love it. Well, Amanda, thank you for taking the time to come on here. If someone wants to learn about Barney, get on your newsletter, or just see any of the stuff, amazing content you guys put out, where's the best place to go for that?
Website, wearebarney.com, and LinkedIn is always a great place to reach me.
Awesome. Well, thank you very much for taking the time today, Amanda.
Thanks, Jake.
Thank you guys for listening. Hope you got a ton of value out of this episode. Until next time, I hope you are working without pants.